thank you for joining me. My name is Chloe McCulloch and I'm a business specialist at SAC. And in common with lots of my colleagues, I really enjoy looking at sets of farm accounts. Not so much because I enjoy looking at lots of pages of numbers, but because I like to know things, and a set, or ideally 2 or 3 of accounts, tells me lots of things about a farm business, how big the operation is, what type of business it is, whether it's owner occupied or includes rented land, if there's lots of machinery and metal, have they been investing in buildings. So I get lots of information from a set of farm accounts, and if you know where to look, they can be really instructive. So I'm going to assume that you will know if you have a new car, or you've built a shed this year, or if you're a hill sheep farm, or whatever. So this session is going to focus on the things that will tell you something as the business owner. From the outset, I'll say that some of the things that we're going to look at are things that you need to know, and they might not be the most interesting, but they are important because they give background and context to everything else. And some of them are really informative or instructional whenever you look at the accounts. A key thing to bear in mind is that although your accounts might look a bit different to the set that I've prepared, and I've emailed round as many people as I could with the accounts before the event, so hopefully you've had a chance to have a wee look at them. If not, they will be sent out again afterwards, and you'll be able to see on the screen when I'm working through the accounts. So a key thing to bear in mind is that although your accounts might look a little bit different to the set that we're going to look at tonight, the accountant prepares the accounts in line with a set of international standards. So the international accounting standards are what dictate what goes into your accounts and how the information is prepared and presented. So although they might look slightly different visually, there shouldn't be any substantive differences between the accounts that your accountant produces for you or accounts for any other farm in Scotland or elsewhere. So the first need to know thing is that the accounts of almost all farming businesses are prepared on the accruals basis. And this means that they reflect the transactions that have taken place during the year, irrespective of whether cash has actually changed hands yet. So for example, during 2019-20, Morven sold some seed potatoes. She sold them for £125,900 and she's issued an invoice, but she's only received £15,000 in cash so far from the person she sold them to. But the accounts will reflect the full £125,900. So looking at the accounts, we're going to start at the top and we're going to work our way out or down from there. So the gross output is the sales less the purchases adjusted for the valuation. And if that's a wee bit confusing at the moment, bear with me because we're going to look at that in a bit more detail now. So remember, the accountant is producing accounts which are a fair and true reflection of the business performance. So with this in mind, we're going to have a look at an example here. So this is Mary's farm. On the 1st of April 2019, she has 30 in-calf heifers and each of them are valued at £1,000. So she has £30,000 worth of cattle. During the year, all these heifers are going to calve, and by the end of March 2020, 12 months later, she has 30 heifers all with calves at foot, and she's had them valued at £1,500 each. So, what is Mary's cattle gross output for the year, assuming she doesn't make any sales and she doesn't make any purchases? So what is the output from her business during the year? What has she actually produced? What value has she added to the business during the year? Is it £30,000? Is it £15,000? Or is it £45,000? Okay, so I can tell you that the answer is B, £15,000, and most people got that. So she didn't make any sales, but she has added £15,000 to the value of her heifers simply by keeping them and calving them, and she'll have spent money on these beasts. She'll, getting them to this point, And the money that she spent on these animals will have been included in her accounts. She'll have had feed bills, she'll have had vet bills, she'll have had expenses associated with getting these heifers all calved and safely to the end of the year. So it's fair that the increase in value from these cattle is reflected in the accounts. It wouldn't be a fair and true reflection of her business performance if the only bit you saw was the expenses and you didn't see any reflection of the extra value that she's created. It's slightly more complicated if you have sales and purchases. So now let's imagine that Mary has bought and sold some cattle during the year, as well as having these 30 heifers. So then the calculation that we're going to use is sales less the purchases, and then we're going to add in a valuation change. So Mary sells heifers. The easiest way is to look at an example here. So she sells heifers for a total of £10,000 during the year, and she buys heifers for a total of £5,000 during the year. We saw a moment ago that at the start her stock was worth £30,000, and at the end her stock was worth £45,000. So the valuation change is effectively £15,000. The stock on the farm is increased in value by £15,000. So if she buys stock for £5,000 and sells £10,000 worth, and between the start and the finish of the year, her change in valuation is £15,000, what is her cattle gross output for the year? So is it £20,000? Is it £10,000? Or is it £15,000? So remember, we're thinking about the sales, less the purchases, and then we're adjusting that for the valuation change, so we're adding the valuation change on there. So the answer there is A, £20,000. So her sales were £10,000, less her purchases, and then the change in valuation between the stock she has at the start and the stock she has at the finish. And whenever your accountant is producing your accounts, they are doing effectively the same calculation. They're considering the sales of cattle or sheep or crops that you make during the year. They take off the purchases of cattle or sheep or crops that you've made during the year, and they consider the value of the stock at the start and the value of the stock at the end. So when they arrive at this figure for gross output, that is a fair and true reflection of what the farm has produced during the year, even if they haven't all been sold yet. So if we go back to our accounts, you'll notice that they refer to Note 1, and you can find out more information on what's in the gross output by looking at Note 1, and this is Note 1 here. So the accountant has separate calculations and separate columns here for cattle, sheep and crops, and then they total them up on the right hand side. Now don't be alarmed at the way this is set out. They set it out a little bit differently to the way you or I might, but the effect of their calculation is exactly the same as the one you did on the previous slide that the majority of people were getting right. So don't worry. So instead of working out a valuation change, the accountant will use the formula sales plus closing stock, and then they will subtract purchases and opening stock. But it's exactly the same calculation that you've done. It arrives at exactly the same number. So in the case of J&M Brown, this example business we're looking at, they had a slightly higher value of cattle at the end of the year and a slightly lower value of sheep at the end of the year, but generally their opening and closing stock didn't change too much. We can go a little bit further and we can look at the valuation, and I see a question has come in, somebody's asking about the valuation, so that's really good timing. So we can go and look a bit further and look at the valuation, and the valuation is in Note 3. So Note 3 gives us the trading stock. This is the end of year valuation. You'll be familiar with the accountant asking you for your stock numbers. So it's got the stock for cattle, it's got the number, and it's got the value. One thing you might notice is that the values will seem very low. These are particularly low values, but it is not at all unusual for the values to normally seem a bit low. And this arises because, firstly, in representing a true and fair view of the accounts, it's clearer what's going on if there isn't a sense of livestock values fluctuating up and down a lot. So did the profit for the year increase because the farm made an increased output or controlled costs better, or did the profit increase because there was a £5 or £10 a head increase added to the value of the cattle? You know, we don't want to make the accounts fluctuate over relatively small amounts, which you could probably argue over. So the accountant will generally be trying to keep these numbers fairly steady. They need to be reasonable, but they want to keep them fairly steady rather than fluctuate them up and down all the time. The other thing is that what your best stock make, if you ask any farmer, you know, what's the stock worth, the figure that they'll have in their mind is normally the figure that the better stock make. Whereas what the accountant's doing here is, you know, in the case here of these beef cows, they're looking at the number of beef cows, but if those beef cows were all to be sold tomorrow, some of them would make great prices, some of them would be fairly average, and a few of them might even go off as cull cows. And so the average value would be taken here. The other thing is it will also not include the cost, the mark commission. So this will be what you would receive from the sale of the animal, not necessarily what the hammer price was expected to be. If you have queries about the values that are used in your accounts, though, the accountant will be able to explain why they've used what they use. Some businesses will have more flexible valuations that take into account actual values. So for instance, on our farms at SRUC, a valuer will come in every year and give a reasonable market value for everything at the year end. But in the majority of farm businesses, the accountant will agree with you what a fair value for the stock would be. Now, herd basis versus trading stock. I think it's fair to say that the rules around herd basis are complicated, and I don't think you'll feel any better for knowing them, honestly. The key thing to bear in mind with the herd basis is that the cost of replacements and the money that you receive in for culls, they don't appear in your gross output calculation. So if your herd is on your balance sheet on the herd basis and not as trading stock, then when you sell breeding cattle or you buy breeding cattle, they are treated more like additions or disposals to a capital asset in the same way that machinery are. We'll have a look at that shortly. If you use the herd basis, you have to elect to do so with HMRC relatively soon after establishing the business, or relatively soon after you change the partnership. So many businesses that have the herd basis will do so because it was quite a historical decision, not necessarily because it's something that the accountant thinks from one year to the next is necessarily of any immediate advantage. But no, basically on trading stock, many businesses, the stock are classed as trading stock, and the change in valuation of the stock, the change in valuation of the breeding stock will change your gross output figure. In other businesses, probably a smaller proportion of businesses, the herd will be treated, the breeding herd will be treated more like a capital asset. And in those cases, they'll have the breeding herd as the capital asset, but they might also have trading stock as well, which is the non-breeding element of the stock. It's a question for your accountant if you'd like to have more information about why you either use the herd basis or don't use the herd basis. So then we've got the total output. So we're down now quite near the bottom of the first page of the accounts. So we've got the other output. So we've got wool, basic payment scheme, way leaves, things like that. Now you'll notice we've got the subsidy income in here. With subsidies and grants, the general approach is that the treatment of the grant follows the treatment of the thing that it's for. So subsidies and most environmental grants aren't actually capital grants to pay you for doing capital works. They're normally generally reimbursing you for expenses that you've incurred, or they are compensating you for income foregone. So those types of grants and subsidies tend to be included in the income. If you get a capital grant for something like a shed, it's more likely to be treated as capital income, and it won't appear in your profit and loss. Maybe a wee bit more on capital items later. So in this business, if we add the other income to the gross output, we get £131,796 of total output. And if you just keep that figure in the back of your mind, we're going to have a look at that as we get a bit further on. So back to the main accounts, we've looked at gross output and how that's calculated, and now we're going to go on and look at variable costs. So variable costs are all the things that are expected to change up and down proportionately as the number of stock or the acres of crops is increased or changed. So if you have more barley in the ground, you'll use proportionally more of your barley sprays. If you reduce your sheep number, you should expect your sheep vet bill to reduce in the same proportion. So variable costs are things which, generally speaking, will flex very readily as you increase or reduce the size of an enterprise. Then we've got these costs here, which are fixed costs. They might also be called overheads. They might also be called expenses. And although we've got them all shown here as one big long list in alphabetical order, some accountants might helpfully group these into administration expenses, power and machinery expenses, labour expenses, etc. So fixed costs or overheads are things that generally don't flex as readily with the area of cropping or the number of livestock numbers to a point. So if you go from having 200 dairy cows to having 203 dairy cows, your variable costs will increase because you're feeding another 3 cows, you've got the added vet bills of another 3 cows, but your fixed costs won't. It will take just as much machinery. It probably won't take any more diesel to mix the ration for 203 cows rather than 200 cows. It'll take just as much time for milking, so on. But if you make a big change in numbers, your fixed costs could well change. So you might go from 200 cows to 300 cows and find that you need a whole new milking parlour, a bigger shed to go up a size in the feed wagon. So we talk about fixed costs. It is important to just bear in mind that fixed costs are only fixed to a point. And expansion is only helpful in keeping your costs down to a point, because there does come a point when your fixed costs, even your fixed costs, will change. Another key concept for us to have a look at here is that of trading expenses versus capital expenditure. So you'll notice that there aren't any lines here for items, purchases of machinery or loan repayments, and that's because those are capital items. So with a capital item, you are buying something that you are going to use to make a profit. So a piece of machinery, a milking parlour, a shed. If it's a trading expense, and that's the things that appear here in the fixed costs, these are just the costs of producing the thing that you are producing. So if you take a tractor as an example, if you are a tractor dealer, then the purchase of a tractor may well be a trading expense, because you're going to buy that tractor. Your business is selling tractors, and that is going to be sold as part of your business. So that may well be a trading expense. If you're a farmer and you buy a tractor, you're not in the business of buying and selling tractors. You're in the business of producing livestock or producing crops, and the tractor is simply a tool that you're going to use to help you to produce those crops or livestock. So things which are there and their job is to assist you in producing what your farm produces will tend to be capital things, and things which are pretty core, like the vet bill or a feed bill, those will be expenses. Now, if you put the capital expenditure into the profit and loss account, into the accounts every year, then what you would find is you'd get big swings in profit simply because of when somebody made an investment in a piece of equipment, or when they changed the bike, or when they replaced a big expensive item. And it wouldn't give a fair and true picture of the business, how the business is trading during the year. So you'll notice these boxes here that are highlighted in red. The depreciation figure is how we treat the purchase of capital equipment in the accounts in order for the accounts to reflect this true and fair picture of how the business is trading. And if we go to the relevant note, in this case note 2 of the accounts, we can see some information about that. So the table in this part of the notes gives us lots of information. It tells us about how much these assets are worth according to the balance sheet, according to the accounts. It tells us about the things that we've bought and sold during the year, tractors, plant, equipment, land, and so on. And it also tells us how much of the cost of that item is deemed to be attributable to the current financial year. So as an example, heritable property. Now, heritable property, you might also see it in as land and buildings. Often this is a very historic valuation. So it might be the value when the farm was first purchased, if there hasn't been a revaluation since then, and that could be many decades ago. So you might see a heritable property figure that is, a fraction of what the farm would actually make if you sold it now. But it won't necessarily include the value of the farm at all. So that's probably a good time just to mention the difference between partnership assets and partners' assets. So a partnership comprises 2 or more partners, and they'll have a partnership agreement, and that will set out how the profits and losses are shared and how much each partner is entitled to of the partnership assets. But these can be different. The business might use assets that belong to one of the partners, but these aren't the same as them being partnership assets. It's easiest to think about if I show you an example. So we've got a married couple, Fiona and James. Fiona and James farm in partnership. The farm itself belongs to Fiona. It is not a partnership asset, it belongs to her, and it doesn't even appear on the balance sheet. But then they go and buy some land jointly as the partnership, using the partnership funds, and that does appear on the balance sheet. So in some cases, every situation is slightly different, but if you think that the farm isn't included as the heritable property on the balance sheet and you're wondering why, it's probably because it belongs to one of the partners and it isn't strictly a partnership asset, therefore it doesn't appear on the partnership balance sheet. The partnership simply use the farm. Heritable property isn't normally depreciated. So in the example we're looking at here, there hasn't been any valuation change in the heritable property. They haven't bought any, they haven't sold any. You're not required to update the valuation for your heritable property with any particular regularity, but if you did have a valuation, the accountant would be expected to use that updated valuation in the balance sheet because they have to use the information that's available to them to provide this fair and true reflection of the business. So if you had the farm revalued perhaps as part of a lending package and there was an updated value available, the accountant is more likely then to put the updated value on, but you don't normally have to do it specifically. Improvements, many people will have improvements on their balance sheet. These normally relate to things that are built on the farm. They might also be called tenants improvements, even if the business isn't a tenant in the true sense. So this is where you'll see structures that you've built. There may well be depreciation, and where the depreciation is of a building, it's normally on a flat rate. So for instance, the building costs are written off over the period that the building is expected to last. This is called straight line depreciation. So for example, you have a building, it costs £300,000 and it has an expected lifespan of 30 years. To produce a true and fair reflection of the financial performance of the business, you would allocate £10,000 each year to the profit and loss. Simply the cost of the building and cost of the capital item divided by the lifespan it's expected to have. So the cost of the building is apportioned out along its lifetime, in this example here, at £10,000 per year. So back to our fixed asset schedule, and just looking back in the improvements column there, in the case of JM Brown, the depreciation charge for the improvements here is £1,375 each year. So that's how much of the improvements cost is deemed to be attributable to each year of trading. On to machinery and plant. This is where you'll see plant and machinery sales, purchases and depreciation. In some accounts, you'll see things like tractors also included here, but in some cases those might be split out. So you might actually have extra columns in your fixed asset schedule with tractors split out separately. You'll notice on the right hand side you can just about make out motor vehicles. I'm not going to talk about motor vehicles separately because the same basic rules apply as to plant and machinery. This will also include some things that you might not think of as plant and machinery. Milking parlours, grain dryers, equipment like that would also be considered plant and machinery normally. Plant and machinery is normally depreciated on what we call the reducing balance basis. So in the reducing balance basis, that reflects the fact that when you go and buy a new tractor and you get it home, in the first year of having the tractor, you will get the biggest reduction in its value in that first year. By the time you've had the tractor for 20 years, the change in its value between year 20 and year 21 is probably pretty minimal, but you get the biggest chunk of the depreciation right at the start soon after you've bought it. So machinery and plant is normally depreciated on the reducing balance method. Often 15–20% is used. Your accountant will decide what's the most appropriate figure for you, and you can ask them about it. But if a tractor costs £60,000 and it's being depreciated on a reducing balance at 20%, in the first year the depreciation is 20% of 60,000, so 12,000. And the net book value of the asset, so that's the amount that will appear in the assets section on the balance sheet, is £48,000. So at the end of year one, we have a tractor worth £48,000, and this 12,000 of depreciation will be an expense in the profit and loss. In year two, the depreciation will be 20% of this remaining £48,000, which is £9,600, and the net book value of the tractor then reduces to £38,400 and so on. So you can see that you get much bigger depreciation figures in the early years when you've just invested in something expensive, and the depreciation that you'll have by the time you get to 10–15 years down the line is pretty modest. This would be a good time to mention capital allowances. So I'm going to ask you to have a think about this statement. The depreciation of plant, machinery, improvements, etc. is an allowable expense for tax purposes, the way that repairs would be. In other words, is the figure at the bottom of your profit and loss account the figure that you are taxed on? So capital allowances, for tax purposes, the depreciation is added back to your net profit, and they use capital allowances instead. And actually, it might not just be the depreciation that's added back to the taxable profit at the bottom of the accounts. There can be some other things that mean that the profit figure at the bottom of your accounts isn't the figure that gets used in your tax return. And the simple reason for that is that there are international standards about how the profit and loss accounts are prepared, what you include when you recognise income, when you recognise expenses. There's a very good set of standards that are in place around the world, and the idea is that wherever you are in the world, you can take two sets of accounts and you should understand whether the two are comparable or not, and you should be able to understand a set of accounts produced in Scotland, in England, in Ireland. They are broadly prepared in the same principles. However, the tax regime changes all the time, and it is very country specific. So the accounts are as consistent as they can be between countries and nations, but the tax regime and what goes in your tax return can be different from country to country. So capital allowances, the only one that we're really going to talk about tonight is machinery and capital allowances. You get an annual investment allowance, which is a tax thing, and that means that the total cost of qualifying assets, and that's most plant and machinery, not the vast majority of cars, most plant and machinery is tax deductible in year one when you buy it. Okay, so what that means is that if you, up to the limit, there's a limit for the annual investment allowance, but up to the limit, if you buy a qualifying asset, so you buy a tractor and you haven't exceeded the annual investment allowance yet, for tax purposes, you'll be able to deduct the whole cost of that tractor in the year that you buy it. For profit and loss purposes and arriving at the profit on the bottom of the accounts, you will only show 15 or 20% of the cost of that tractor as an expense in year one. But the annual investment allowance allows you to offset the whole amount for tax in the first year according to a whole set of rules, and you need to speak to your accountant if you're thinking about using the annual investment allowance or you're wanting help in making decisions. If you don't or can't use the annual investment allowance, you're at the limit, or you don't want to, then HMRC will specify what proportion is tax deductible each year. So if you are already over your annual investment allowance, you still don't use the depreciation figure, you use a figure specified by HMRC for plant and machinery. And currently, depending on the kind of plant and machinery you're talking about, it's between 6 and 18%. So you might depreciate an item at 20%, but if it's qualifying and you're under the allowance, you might be able to offset the whole cost of the item when you buy it in the first place. And even if you can't, you'll then probably get at most an 18% allowance year on year. You won't be able to use the 20% that you might have used in your accounts. I'm not sure why there's a red cross there. I'll keep going. So with the annual investment allowance, you can deduct the full value of this qualifying item from your profits before tax. And it doesn't include cars. There are some more complicated rules if you buy very eco-friendly cars, if you buy electric vehicles. Some electric vehicles, you might get some sort of tax incentive whenever you buy them, but that is definitely something you need to speak to your accountant if you're thinking about something like that. Fundamentally, the government likes it when businesses invest in equipment. It creates jobs, manufacturing equipment or importing equipment, selling equipment, and that's why they have this annual investment allowance. It's fluctuated a bit over the years. And I think this is what the wee cross is supposed to be. It's supposed to come in. It had been £1 million. So up until the end of December this year, the annual investment allowance was £1 million, but this was a temporary increase from the previous rate of 200. They temporarily increased it for 2 years to £1 million, and we now know that they are not intending to extend this increase. So it will revert back to 200,000 after the 31st of December 2020. I understand that those with a financial year which straddles the 31st of December 2020 will get some sort of prorated amount. So if you're wondering about what your annual investment allowance will be for next year, you definitely need to speak to your accountant, because it'll depend, the exact amount will depend on your year end. But it should be somewhere between 200,000 and £1 million. So that brings us now to the bit right at the very bottom of the profit and loss element of the accounts, the profit. So we've got down through all these fixed costs, our total expenses for the year, and then we've got a net profit for the year. And I'm not going to get you to poll, I don't think I'm going to get you to poll here, but have a wee think about this number for a second. What do you think of this number? Do you think it's a good number, a bad number? It's really tempting to look at the number at the bottom and think, hurrah, it's a profit, which is not to be sniffed at. But the real question, and the thing that in my experience most people don't quite understand how to assess, is whether that number is big enough. So making a profit isn't enough. It has to be a big enough profit to do the things that you want to do. So to know whether it's big enough, we have to think about what you need the profit for. Presumably, you want to be paid, and I'll explain in a moment that doesn't necessarily just mean, you know, being paid something like a wage, or, you know, getting a check every month. But the business needs profits to pay the owners of the business for them to take drawings. It needs profit to reduce the amount of debt. So whenever we looked at the list of expenses, if I go back to the list of expenses, when we looked at this list of expenses here, you'll see there's bank charges and you'll see there's bank interest paid. But that's just the interest element of a bank repayment. The total amount of a loan repayment or a hire purchase repayment does not appear here in these expenses. So if you make a loan repayment, say maybe you make a regular repayment of £800 a month, it may well be that only £200 a month of that is interest, and £200 a month then appears in your profit and loss as an expense, but the remaining £600 is a capital repayment and it doesn't appear in your profit and loss. And what that means is that this profit at the bottom, this is after you've paid the interest on the bank loan or the hire purchase agreement. but it doesn't include the repayment of the principal sum itself. So you need profit for not just your drawings, but also to make these capital repayments to loans. And you also need profit to reinvest. So just thinking about the drawings for a second here. Drawings are the money that the owners, i.e. the partners, want to take from the business. Some of it you'll be aware of, some of it maybe less so. So some of it's cash drawn for personal use, and it's easy to think about that as how you're paid from the business. But you'll also often have personal bills that are paid. So your tax bill is paid by the farm. Your pension is paid by the farm. Bills which are technically personal, but that come out of the farm account as part of your package. So those are drawings too. There's goods taken for personal use. So your drawings will include the beef that goes in the freezer, for instance. But it also includes private uses, and that's maybe the one that people think about the least. So if you've got electricity, fuel, vehicle costs, farmhouse repairs, things which you're going to split, part business, part private, the business bit of that is included in the profit and loss as one of those expenses. The private bit of that is included in your drawings and has to come out of the profit figure at the bottom of the profit and loss. So for instance, if you have £1,000 worth of heating costs for the farmhouse and you split it 70-30, £700 will be one of the heat and light expenses in your profit and loss, but the other £300 is your drawings, and that needs to come out of that profit figure at the bottom. Now, drawings are shown in the capital account or the current account, which is in the notes. So in the set assigned round, note 5 is where you'll find the drawings. The capital accounts basically show how much of the business is owned by each partner. You have opening balances, which show the amount at the start of the year, the net worth of the business. And this is the figure that's at the bottom of the balance sheet at the start, and it's split out between each partner. And then you have the figure at the end of the year. So at the end of the year in this business, the value of the business, so if you were to liquidate the business, sell everything, call in all the debts, square everything off, there would be £490,618 left for the partners. And the capital account shows how that amount would be divided between the partners. So in this case, it's James Brown and Margaret Brown. And the amount that each of those would be owed in the event that the business would be wound up is a cumulative picture showing how much they each put in at the start, what share of the profits they each got each year, how much they have maybe put in subsequently, so funds introduced. In the case here, we don't have any funds introduced, but maybe Margaret would put in £500 a month out of her pension or something. That would be funds introduced. And it also shows the drawings each partner have taken, and then it gives each partner's closing balance. So it's the cumulative picture of what they have put into and taken out of the business since either the business started or since they came into the partnership. So that figure, that 490,618 at the bottom, that is what the net worth of the business is, and this shows how that is divided up. So back to our profit figure, the net profit figure for this business is 32,253. The drawings figure from the capital account we can see is 27,795. So the profits that J&M Brown need to make, they need to make enough to at least cover these drawings, and they do. The profit is more than the drawings figure. So that's good. But then we also need to think about the other calls on the business profit. And that's probably a good time to have a look at the balance sheet. So this is the most common balance sheet layout. You're maybe less likely to see variation in how this is presented compared to, say, a profit and loss. But again, it's prepared with standard accounting conventions in mind and with the objective of producing a fair and true representation of the business at the end of the year. So the balance sheet and the P&L are, the profit and loss, are prepared on a slightly different basis. The profit and loss is the accumulation of various transactions that take place throughout the year. The balance sheet is simply the position on the last day of the year. It is just a snapshot taken on the very last day of the year, which shows the effect of the various transactions that have taken place. So you'll notice on the profit and loss, it will say the accounts for the year ending, whatever. The balance sheet will say at the 30th of September or at the year end date. So this is produced in order to show a fair and true reflection of the business at the end of the year. And if we have a little look at what we've got on here, so we've got fixed assets. So the tangible fixed assets, this is the figure that was taken from note 2 in the accounts, and we looked at that. It showed the plant and machinery, property, heritable property, and so on. So on note 2 that we were looking at, that showed the additions and the disposals and the depreciation and so on, the figure at the bottom of that, here it is here, the figure at the bottom of that was £652,717. That's the final statements after we've taken the value of all the equipment at the start, all the assets at the start. We've added some stuff, we've removed, disposed of some things, we've depreciated, reduced the values, and that's what we're left with at the end, and that's what's on the accounts. We've also got the trading stock. So the trading stock in this case are the livestock, and in this case the trading stock includes the breeding stock as well. It's the whole stock. So the trading stock, and this figure of 103,240 for trading stock, is the figure off the bottom of note 3. So note 3 was the one that we looked at that had listed out the stock numbers and the individual values, and those come to a figure, and that's what we've got there. And then we've got some things that maybe people are less familiar with in their accounts. So trade debtors or accounts receivable, these are people that owe the business money. So for example, this is the statement of financial position at the 30th of September 2018. If the business had sold some cattle on the 28th of September and the mart hadn't yet forwarded the cheque or the payment, then this could lead to a debtor at the end of the year. So this 2492 could simply be some lambs or some cattle or some crop that were sold quite close to the end of the year and the money just hadn't come through yet. So that's where you get trade debtors. Prepayments are things that you have paid for in advance, and it's easiest to look at prepayments with a wee example. Quite often a farmer will pay for something where part of the cost is for this year and part is actually for next year. Basically, in a prepayment, the accountant is adjusting the year-end accounts so that some of the cost is also carried through to the next accounts. And that bit is put on the balance sheet as an asset to the business at the end of the year. So J&M Brown rent some grass from the 1st of May to the end of November, so a period that straddles their financial year. They pay £1,400 and they pay it in August, which is before the end of the financial year. So in his books, he records £1,400 for July. He probably records £1,400 for August, actually. So the rent goes in as £1,400, it's paid in August, but only 6 months of the grazing relate to that financial year. The other month relates to the next year. So the accountant will reduce the rent paid that's shown in the accounts for 2019 to £1,200. So just reflecting the 6 months, and they will put a prepayment of £200 onto the balance sheet as an asset at the end of the year. And then next year, the prepayment is basically reversed back. It's taken off the balance sheet and moved back to the rent expense, so that in 2020, he starts the 2020 financial year with £200 of a rent charge, and that was for that first month. It could be rent, anything that is paid in advance. Cash at bank is fairly self-explanatory, so we'll move on to a VAT debtor, a VAT debtor. It simply means that when you calculate how much VAT would be owed from the VAT man at the end of September 2018, it would be 3,720. If he does the VAT monthly, then that might be a number that is recognised, because that might be the number that comes in the next month after they've done the VAT return. But if they do the VAT quarterly, it might not. It's simply the amount of VAT that if you were to wind up the business at the end of September, what do you think the last VAT payment would be? That's that figure there. So then that's the assets of the business, the positives. Then on to the liabilities. Trade creditors or accounts payable are amounts that you owe to others at the year end. So that will be predominantly bills. So J&M have received a fuel bill in August, but they haven't paid it by the end of September, so that's a year-end creditor. So it's normal to have trade creditors because inevitably at the end of the year there will be some bills that have only just come in and haven't been paid. That's trade creditors. Accruals. Accruals on the balance sheet, they're sort of the opposite of prepayments. So if a prepayment is where a farmer is paid for something relating to next year in advance, an accrual is basically the opposite. An expense was incurred this year, but it won't be billed until the next year. A common one might be electricity. So you're billed quarterly in arrears for your electricity, and therefore the electricity you might be using close to the year end maybe won't be billed until the next financial year. So again, the accountant is just making a wee adjustment to make sure that it is the fair amount of electricity that is in this current year's account. So to give you an example, in this case it's rent. If the farmer is billed quarterly in arrears for his rent and his year end the end of September, his October bill will be for a period that straddles the year end. And whilst in his accounts he will reflect, £1,200 in October in year 2, in reality only £800 relates to only £400 relates to year 2. The other £800 was for August and September of the last year. So don't worry too much about accruals and prepayments. It's essentially the accountant making an adjustment so that for things that you've either paid in arrears or paid in advance, the correct and fair amounts are shown in each financial year. Hire purchase liabilities normally relate to machinery or equipment that's on finance, and these normally appear as current liabilities. So this amount is what is still owing to a finance company at the year end, at the 30th of September. Bank overdraft. So other liabilities will include, there's the bank overdraft, and in this example there's also a term loan. An overdraft is normally considered a current liability because it can be called up at any time. Loans where they have a minimum or a fixed term of at least 12 months will be considered non-current liabilities or long-term liabilities. So current liabilities are things which would be payable within 12 months. Long-term liabilities would be things with over a 12-month duration. So then we have the total assets less current liabilities at the bottom. And this figure might be familiar if you think back to the capital account that we looked at and the total value and how it was split between the two partners. So this is effectively what would be left if you wound up the business. So if you sold everything owned by the partnership, all the debts collected and repaid, all the loose ends dealt with, this is how much would be left. Now ideally this amount is increasing year on year, and if this net worth is increasing year on year, that means the business is increasing in worth. Now whether that's the bank balance looking a little bit better each year, or the amount of debt being reduced year on year and not being replaced, or the value of the stock increasing every year, or a higher value enterprise being added, you want this number to be increasing year on year. So now we step back to the profit that we were talking about 5-10 minutes ago. So the business profit's £32,253. We had a look at the drawings and established that they needed 27,795 just to cover the drawings needs for the business. What about the other calls on the profit? Well, there's hire purchase liabilities. This is amounts owed to finance companies of just under £30,000. And there's a term loan of just over £172,000. And we can do a calculation, but I can tell you from experience that with a term loan of £172,000 and hire purchase creditors of about £29,000, the £4,500 that's left after the drawings have been covered is not going to be enough. I would think you're going to need £6,000 or £7,000 as a minimum of this profit in order to make the capital repayments of these loans and hire purchase agreements. But every case will be different. That's just a guess looking at this. So my assessment would be that the profit's 32,253, which might look quite good, but the partners want to take 27,000 of that out. That leaves about £4,500, and I would estimate needing 6,000 or 7,000 to make the loan repayments and the capital repayments. So in my opinion, that profit isn't going to be adequate. And what will happen in practice is there isn't a klaxon that will go off and say this profit is not enough. What will happen is that it will just take a bit longer to get bills paid. So what we might see is on the balance sheet, the next thing that we might see on the balance sheet is that next year the creditors figure might be a little bit higher, which basically means there's more outstanding bills at the end of the year because there isn't quite enough cash in the business, so it takes a bit longer to pay things. Or we might see the overdraft going up, because that would be the classic one. If there isn't quite enough cash, then the overdraft might start to go up a bit, or we might see an increase in loans. So there's various things that happen which provide a bit of a buffer, which means that if you just get the odd year where profit isn't quite enough, there's various sources of a little bit of spare capacity within the business. But if the business were to be insufficiently profitable year on year, then eventually, you know, that will start to create problems. So you'll get away with it for a year, but not for the longer term. So it's not sufficient to make a profit. It is just as important that it is enough of a profit. You need to understand what your needs are for drawings, and you have to be clear about how much you think you're going to need to reduce debt by year on year, and that will give you a guide as to the minimum profits that you're going to need. And if you needed help with those calculations, your accountant would be able to help you to work out, you know, how much capital repayment am I making year on year to date. What I thought I would look at now, just for 5-10 minutes or so, is a little bit of benchmarking, because I think there's a common misconception that benchmarking is horrendously complicated or horrendously time consuming. One of the things that you can do with basic benchmarking is you're comparing yourself to other businesses, and the Scottish Government will analyse hundreds of sets of farm accounts each year, and they produce a benchmark data set. And this benchmark data set is available on the FAS website. There's a nifty interactive tool that you can access this data set. And the key thing is that you can use this data set to benchmark in huge detail if you would like to, but it doesn't have to be in huge detail. You can actually just benchmark one or two key pieces of information that you can find on your accounts and compare them with other businesses. So the benchmarks are available here, and if my computer plays ball, I should be able to open these up and let you have a look at the benchmarks tool. Okay, so here is the benchmarks tool. Now I apologise, the text is slightly small, but you'll be able to go on and have a play. This is freely available. The first thing we're going to do is change the farm type. So JM Brown is a mixed cattle and sheep farm, so I'm going to choose mixed cattle and sheep. And then what we've got here is we've got the data is arranged into various tabs. We've got physical data, so this tells us about the farms that are in the data set. And how they're divided up is they're divided into businesses with less than 25% rough grazing, over 80% rough grazing, or the ones in the middle. And then this column in the far right hand side is the upper quartile, so this is the most profitable 25%. So you can decide which of these categories is the one that you want to use for benchmarking. Now it gives you physical information, and that's things like the hectares of different types of crop that they had, what the stock numbers were on average, things like that. The other thing that you can get though, and this is the one we'll look at just now, is the FBI, that's the farm business income, as a proportion of output, as a percentage of output. Okay, so if we go down here, what this tells us is here we've got all the sources of income. So we've got cattle, we've got sheep and wool, other livestock, cereals, and subsidies, diversification and so on, and that comes to 100%. So that is the farm business income. And then we go a bit further down and it tells us how this income is spent. So it starts off, it gives us the variable costs, and those are all broken down into, you know, concentrates, vet and med, seeds, ferts, sprays, and so on. But it gives us the total variable costs as a proportion of the output. So in this example here, on this data set, it tells us that on average for the beef and sheep farms that will be comparable, we think, with JM Brown, the variable costs comprised between 34 and 37% of the total business income. And what we're able to do then is for J&M Brown, if I switch back to presentation. So for J&M Brown, we can look at J&M Brown's variable costs as a proportion of output, for instance. So right at the start, I said that the total farm output was 131,796. So that was the gross output plus the other income. And I said to keep that in the back of your mind. The variable costs for J&M Brown totaled 50,314, and that's readily available on the accounts as well. And then the benchmark figure then from that tool that I've just shown you was 37%. We're going to say that J&M Brown is less than 25% rough grazing, and the figure there was 37%. Or the top 25%, if that's our target, that was 34%. And if I take the variable costs for J&M Brown and divide it by the total output, and this could be you doing this with your variable costs and your total output, I can see that the variable costs for J&M Brown for this business were 38% of the total output. And the benchmark is 38%, and the top 25 are doing 34%. So that tells me how the business is performing in terms of what proportion of its output goes on total variable costs compared to the benchmark. It also tells me that if, for instance, you know, what's the prize worth? If J&M Brown was able to get their variable costs down to 34%, you know, without impacting on output, if they could get their variable costs down to 34%, i.e. to the performance level of the top quartile, what could that gain them? And that could gain them about £2,000. So it suggests that there's a little bit of improvement they could make, but it's not vast. But that's just the variable cost benchmarking. If you look back on if you look at the data set, there was, let me pull it up. We've got the variable costs all broken down as a proportion of total income. So you could compare any of your variable costs with the benchmark. It's also got fixed costs, and it's got fixed costs in aggregate, and it's got fixed costs categorised into groups. And again, if you wanted to have a look at your accounts and take it the next step, it would be to get a calculator and a pencil and work out, well, what proportion of my farm business income is spent on variable costs? How does that compare against the group that I identify with in the benchmarks? And what do my variable costs look like in comparison? My fixed costs look like in comparison? Do I want to drill down a bit further and work out what my power and machinery costs might be? And I want to look at what my subsidies might be. So you could do as little or as much benchmarking as you like, but it will take you at most 10 minutes with a pencil and the back of an envelope to work out some very key measures against this benchmark for your business. There are some other good data sets available. So the one that I've shown you this evening is the whole farm benchmarks that are available on the FAST website, and these are the data sets collected by the Scottish Government as part of a national survey. The other way that you could benchmark, for instance, particularly livestock variable costs, would be to take the QMS, cattle and sheep enterprise productivity books. They are produced, they're freely available on the QMS website, and those give you the cost not as a proportion of total farm output, but per cow or per ewe. And then you can multiply up per cow or per ewe, you know, the number of stock that you have. So for instance, you could look at what the typical variable cost was per cow and per ewe for vet and med from the QMS data set, and just multiply that up by the number of cows and the number of sheep you have to give you a total, and then compare that with what you've got in the accounts, and that will tell you where you are compared with the QMS group. So there's different data sets, and if you're interested in benchmarking or dipping your toe in benchmarking, the best place to start is to speak to your advisor, contact the Farm Advisory Service and ask for a bit of help, because you'll be able to have a chat through with what might be the most appropriate benchmark set to go for, and make sure you're happy that you know how you would do the calculations. So we'll come on to questions in a moment, and if you have questions, do let me know what those are, and we'll come to those in a moment. But in summary, that's the basis of what I wanted to talk about tonight. So in summary, the profit and loss report looks at the gross output of the business, not just the things that were physically sold during the year. So it reflects all your efforts during the year and the increase in value that you've created, not just what was physically sold. The costs of the business are split into variable costs and fixed costs, depending on the extent to which they flex with enterprise size. Customarily, variable costs are feed, fertiliser, seeds, vet and med, and customarily fixed costs are power and machinery costs, fuel, labour costs, rent, finance costs. The profit of the business has to be sufficient to meet the needs for drawings, for debt reduction and reinvestment. And it is possible with a few minutes in a calculator to have a stab at what seems to be the figure that is the minimum amount of profit that you need. And certainly your accountant or your advisor should be able to help you identify how much do you need by way of profit in order to be going forward. Depreciation is not a tax deductible expense. They use capital allowances instead, but the amount of capital allowances is changing. So that's one to speak to your accountant about if you're planning big machinery purchases. And look at available benchmark data sets that would seem to give a good comparison with your business. Pick out some headline figures to start, some fairly basic figures, start quite simply or broadly, and have a wee look and see how you compare to that business. And then you can start drilling down a little bit further, and that will help to put the information in your accounts into a little bit more context. We've got some questions coming in about starting bookkeeping. We do have a bookkeeping technology, modern bookkeeping technology meeting, which will be in about a fortnight's time. So if you have a look on the events page of the FAS website, you'll see that, and you can book on there. And if you have a look on the FAS website, we do have a set of resources around bookkeeping. I'll just show you where those are quickly. If you go into the FAS website and go to Rural Business and go down to Business Tools, we've got a variety of things on the website here. And we've got some information here on bookkeeping and farm accounts. And it's worth saying that the information on the FAS website is being updated all the time. So do keep an eye on what's here. And if there's information that you'd like and you don't see, do feel free to shout. But there are some practical guides on double entry bookkeeping, journals, business finance, VAT basics. There's a guide that accompanies this evening's event on understanding the accounts that will give you a summary of the terminology. And there's other information about Making Tax Digital and so on. So do have a look on the business section of the FAS website. There's more resources there. Someone's asked about self-assessment, going down the road of Making Tax Digital. Yeah, we've got a few questions coming in here about Making Tax Digital, so just a couple of minutes on that. HMRC's direction of travel, or the goal that they want to get to, is that self-assessment, all taxes, all income tax will be digital, and they will have far greater control, and this will help them to recover far more tax money than that they ought to, that they maybe are missing out on currently. There's a thing called the tax gap, and the tax gap's the difference between what they might calculate should be collectible and what is actually collected. So they want to reduce the tax gap, and at the current time they will be particularly keen to reduce the tax gap and make sure they get as much of the fair tax collected. So at the moment, their starting point was VAT, and their starting point applied to businesses with a taxable turnover of above the VAT threshold, that's £85,000. They had to use digital software to keep their records digitally and submit their VAT digitally. From April 2022, all VAT registered businesses will need to do making tax digital, irrespective of their taxable turnover. If you're registered for VAT, you will have to keep the books digitally and submit them digitally from 2022. And then it will be, we suspect short steps, but quite how short we're not sure, to everybody, irrespective of VAT registration, having to keep their books digitally and submit things digitally. And what HMRC want to get to is a position where you submit income tax related information quarterly as well, and then you just do a sort of tidy up at the year end, rather than them getting a big surprise when everybody puts their tax returns in. So making tax digital, it's continuing to be expanded out, and it will cover all farmers from April 2022, because the vast majority of farmers are VAT registered. You can register for VAT if you've got a taxable turnover of less than £85,000, so you don't need to wait till you get to the £85,000 threshold to register for VAT. But currently, and for the next 18 months, you only need to do making tax digital if it's over £85,000. Okay, if there aren't any more questions, I think that's probably time for me to thank you finally. Thank you for having me. Thank you for displacing whatever exciting things were on the TV tonight. I really hope that this has been useful, and if you've got any queries, feel free to get in touch.